Hey everybody, welcome back to Four Stars, today's Market Explained. I'm Brian Castle, your host, and I have with me, of course, as usual, my amazing co-host, Mr. Christopher Reardon. Chris, welcome to the podcast.
Thank you, Brian. Good afternoon, everyone. Glad to be here. Glad to talk a little bit about the markets and what's going on out there.
And for those of you who are new, Chris is the Director of Development at FourStar Wealth Advisors. He directs all things regarding investment management and advisor recruiting and products and services that are all the important things for investors at FourStar. And he's from Cleveland. He has a young family. And Chris, you're an amazing guy. Welcome again to the podcast.
Thank you, Brian. Glad to be
All
here.
right. And I'm Brian Castle, your host. I'm the CEO and founder of FourStar Wealth Advisors. I'm an advisor to CEOs and insiders of companies. I'm a trustee of the National Boy Scout Foundation. And I'm most importantly husband to the amazing Tripty, who is now the president or the CEO of the World Council, Women's Council of Realtors of the National Association of Realtors, my wife Tripty, and our two boys, Evan and Quinn. I'm chief dad to them. Those are the most important jobs. Anyway, that's where we are, folks. That's our lineup for today. Chris, um, tell us what's going on in the markets first, and we're going to talk about the economy, and then we're going to talk about what we see out there and an "Are you kidding me" segment. So let's start out with the markets, Chris. What do we see out there in the markets?
Yep. So, I think it's interesting with the asset classes. Not a whole lot of change. I think the last time we did a podcast, we kind of spoke about we were almost in a stalemate. But we did see a little bit of movement at the top. So we do have a number one overall, and that's domestic equities. It's at 299 tally points. It actually lost 2 tally points from our last podcast, but still overtook international equities for that number one position. International equities is in the two. It's at 298 tally points, so it's 1 point off. It's right there. The reason for it dropping is because it lost 6 tally points since our last podcast, so it dropped down that one. That was pretty much the biggest movement, I would say, since the last podcast that we've seen. Commodities is at 172 in third. It's actually -1 from the last podcast, but it's been really interesting that the commodities asset class as a whole has really kind of done a dip down and now has kind of come almost roaring back up. So it's been pretty volatile these last couple months. Cash has been
Yeah.
stagnant in that fourth position at 121 tally points, and that's equal. Currencies is at 104. And that's actually equal since the last podcast as well in fifth, and fixed income is at 86 tally points and equal as well. So the bottom three asset classes still very, very stagnant. I'm not seeing a lot of movement upwards in cash. Most movement we've really seen has been commodities related, and domestic equities, international equities, any of that movement. So, but an interesting market overall. We're starting to see a little bit of that stalemate break, and I think that we'll see what this the rest of this year brings. We're kind of ending the tail end, coming up on fourth quarter. We'll see how things end up.
Well, and the thing that I continue to look at, Chris, is that fixed income is ranked last now consistently for almost 5 years, since 2022. And it's a sad story, but fixed income is still a storehouse of value. So you're not going to lose a lot of money in fixed income, but you're not going to make a lot either. But all the other asset classes seem to do better.
Yep, and it's getting almost like a tougher market right now for fixed income because there's talk now of potential the Fed raising rates again, things like that, and that hurts the fixed income market. So we'll see how it plays out, but things aren't looking good for fixed income, let's say that.
No, not at all.
Switching over to the sector performance, energy is still retained that number one spot as far as sectors. It's up 43.71% year to date, and that's plus 11.44% from the last podcast. So energy continues to push upwards. A lot of that is due to the Iranian conflict, everything going on there. That we're seeing that. Technology is in that second position, still holding that solidly. It's up 28.22% year to date, and that's still up 10.29%. So that continues to still push, albeit it's gets a little bit of volatility spikes, I would say, in there. Industrials is holding the third, and this is a bit of a drop off now. We're at 19.07 year to date up, and that's only gained 1.78% since the last podcast. Real estate in fourth, up 13.29, and that's actually lost about 3.5% since the last podcast. So a little bit of a pullback in real estate. Materials moved up from sixth to fifth. It's up 12.66%, and pretty much flat. It's up 7.7% since the last podcast. But healthcare is the big one, and that continues to run. Healthcare has been one of the strongest sectors, I would say, the last month, to maybe 2 months. It's up 11.68%. It's up 2% since the last podcast, and that's bumped up another position from seventh to sixth. So what those bumped out, consumer staples, which is kind of unexpected, I guess. When you think of volatile markets, things like that, you think consumer staples is almost a store of value, right? That safety. But consumer staples is actually down 2.3%, now up only 11.58% year to date. And like as I said before, it moved down 2 spots overall.
Oh,
Financials has been another one. If we rewind back 4 or 5 months, financials and healthcare were both kind of the seller. Now financials has kind of made a bit of a run here. It's up 7.02%, up about 1.5% since the last podcast, and that moved from ninth to eighth. Utilities has been the big one. So this used to be in the top half. I would say, I think at one point in the top 4. Now it's down to 9 out of 11. So really has fallen. It was down 3.19%, and it's only up 5.25% year to date. Once again, dropped down 1 level there. And then the bottom has really stayed pretty consistent the last couple months now. Consumer discretionary up only 0.54% since the last podcast, or year to date, I should say, and up 3.5% since the last podcast. And communication services continues to be the worst performer by a pretty significant margin. It was down 3.5%, so negative 3.5% year to date, and gained, but only gained 0.87% year to date. So some movement here. I think obviously the high flyers continue to really be energy and technology. I think kind of continue to joust back and forth. Industrials is still holding in there, but we've seen materials kind of taper off, real estate's kind of tapered off, and healthcare, I would say, from where it has been, has really made a pretty significant move. But it still has a little bit to go if it wants to start to pressure up in that, the top 3 as far as sector wise. So we'll see. The trend has been with healthcare, I would say. So we'll see if that does continue or not.
So Chris, if I could just chime in a little bit here, I'm amazed at the divergence between the groups, right? So we talk in terms of the S&P 500, and there's 11 industry groups, and the number 1 group you mentioned is energy, up 43% for the year, and the number 11, the worst group, is communication services, down 3.5%. So they say that you can't beat the market, right? But what if you had most of your money in energy, up 43, information technology up 28, industrials up 19, and real estate up 13, like those top 4. And let's say you didn't have any money in the bottom 4, financials up only 7, utilities up only 5, consumer up 0.54, and communication down 3. You'd have a much better return than the index, wouldn't you?
I mean, 100%. I think where the general investor might struggle with that. So it could probably have a little extra volatility, especially with those top 2.
Yeah.
So you have to be willing to kind of bear out some of those pullbacks and not, panic, right?
Well, right. And I'm just pointing out for the folks listening to our show today that that's exactly what we try to do. It's called relative strength. So we overweight and include the areas of strength, and we underweight or eliminate the areas of weakness, trying to beat that benchmark. So if we're trying, you have to beat a benchmark, you have to diverge from that benchmark in a material way. And this is the material way that we try to do it. And we've generally been able to do that, to beat benchmarks. But then there's pivot shifts throughout the year and things like that. So we're always watching that very closely. But I'm just shocked at the difference. It's a 47-point difference between the top group and the worst group. 47% difference. It's amazing. Just this year to date. So anyway,
Mhm.
I just thought I'd point that out, everybody. Chris, there's some more market themes that we could talk about too, right?
Yeah. So since the last podcast, we had the Fed held their kind of first decision meeting, one of their most recent decision meetings, I should say, and they voted 9-3. And that was the end of July to keep the funds rate at 3.5 to 3.75. That's the fifth consecutive meeting they've kind of held interest rates. I'd say interesting. There were three that did dissent, and so that's the most since September 2016. And, is that a signal that there's starting to be a little bit more momentum towards holding the rates steady and potentially a rate rise? And, the market's starting to kind of project that in a little bit more. And I know we'll talk about that a little bit later.
Mm-hmm.
But on the switch back to the market a little bit, earnings have really been, I'd say, the main point with the market. More than 90% of the S&P 500 has now reported their Q2 earnings, and they're tracking near 50% year-over-year growth, which is the strongest since Q2 of 2021. So even with the backdrop, things like that, in these earnings, these companies, obviously with this AI powerhouse, if you will, behind it, continues to just push forward. I think where it gets difficult is as you continue to hit these records and these year-over-year growths, you're kind of it's you're hurting yourself to a degree, because at some point it's going to slow, and when it does, a lot of these companies are going to get dinged. We'll see, but they have met up to the standard so far with what we've seen. Earnings have been a big part of that. The bond market, though, has been probably the biggest signal. The 30-year Treasury yield reached 5.32%, which is the highest since 2007. So we continue to see those long end yields pushing higher. A lot of that is because obviously the expectation potentially that the Fed is going to maybe raise rates. But I think the bigger backdrop of it is now the U.S. debt, which is at over 40 trillion. Obviously the higher debt, now we're starting to hear rumblings in the media of a potential, bond drop again, grade drop there. So, there is ramifications for that. And is that, they won't just let it go up to infinity and not take any action. So we are starting to see those treasury yields get a little bit higher, and we'll see how that happens, or if that does continue from there. So, and then the last thing I'll mention is in the near term. Obviously, we have this week we have the FOMC minutes. Actually, that was last week. We had the FOMC minutes, which came out, which once again highlighted, I believe, that the potential for a rate hike in the near term, kind of Q3 or any Q3 or beginning of Q4 is I think getting more probable, more on the table. And then we have the Jackson Hole meeting. That's going to be really big, as that's going to probably provide the biggest viewing guide into the policy roadmap before the next meeting, as far as what the expectation is. So that's this week. That happens this week. So we'll see. Those have two potentials to really cause some volatility in the market, both potentially good or bad. So we'll see what what happens there.
All right. Well, we'll see what happens in Jackson Hole. And that's going on tomorrow, actually, as we tape this. So great. All right, folks. Well, in our next segment, we're going to talk about the economy. We'll be right back. Brian Kasal. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Okay, welcome back. It's time to talk about the economy and what's driving all this stuff in the market. Chris, how did GDP come in?
Yep. So Q2 GDP came in a bit soft. The advanced estimates, that's the first estimate, kind of put real GDP growth at 1.5% annualized. That's down from 2.1% in Q1. And that was below the 1.8 to 2.1% range that was the expectation of economists. So consumer spending and investment and exports were the kind of highlights, if you will. But a downturn in government spending and higher imports were kind of the main detractors of that. So first readings are always tough. Obviously, they'll get more refined as we get to that second, third, and the final readings there. So, but Q2
Okay.
price data embedded in it. Q2 price data embedded into the GDP was hot, with the PCE price index running at 5.1% annualized, core PCE up 3.4%. The gross domestic purchases price index rose 5.7%. So what we're really seeing, what this kind of really highlights, and this PCE really is a good highlight as far as what is going to actually be working its way through the economy. It's showing the energy shock working through the corner. So you continue to have these energy shocks from the Iranian conflict really play out. It's really hard to get a read. We've had obviously peace negotiations, things like that. The market's just getting whipsawed, if you will, up and down. So
Yeah.
we'll see. And then trade improved at the margin. So June goods and services, the June goods and services deficit narrowed to 73.5 billion from 77.6 billion. As imports fell more than exports. So we exported a little bit more goods than imports, which helped the overall GDP.
Okay, well, so Chris, turning to inflation, the July CPI landed exactly on consensus. Headline CPI rose 0.1% month over month and 3.4% year over year, down a little bit from June, but core inflation rose 0.2 and 2.5 year over year, down from 2.6. So matching the core. Still, however, the numbers are still high, right? We're still above that 2% target that the Fed wants. Shelter, which is housing, did most of the work, accounting for roughly 2/3 of the headline increase. And owners' equivalent rent, the stickier measure, also rose. Energy is the whole story, though, in the year-over-year figure. Energy this time, however, fell 1.5%, and that's why there was a little bit of a pullback, but it still remains 14% higher than a year ago, with gasoline up over 24% over the last 12 months. So any narrative about disinflation has to reckon with the fact that this component is hostage to the Straits of Hormuz. Uh, so that's just how it is right now until they solve all these things. And we're going to hear a little bit more about what's going on in Iran. Services pressure has not gone away. Medical care rose 0.4%. Airlines fares jumped, and I travel a lot. I've seen that every day, jumped 2.2%. Communication, education, recreation, all increased. Motor vehicle insurance was among the few major categories that actually declined, strangely enough. Food inflation cooled. The food index rose only 0.1%. So July PPI, the producer price index, was generally dovish. Final demand was flat against a positive 0.2. So that kind of came in line, and that's pretty good, actually. And then the PPI, excluding food and energy, rose 0.4 in July after just a 0.1 increase in June. So it's still up 4% year over year. So still inflation for services as well. And forward risk to the flag, the several economists have pointed out that fertilizers and energy costs filtering into the fall harvest could knock food prices up a lot higher. So the energy shock still has a long tail through the supply chain. So Inflation's still a problem. There was hope that they would lower rates, but when we have this kind of inflation scenario, Chris, it's going to be hard to see them lower rates. If anything, they might have to raise rates, which has been everybody's concern. So
Yeah.
we'll see where that happens. How about the consumer, Chris?
Yeah, and one thing, I mean, I think that's important to point out that PPI number, albeit I think that is a little bit more promising as far as being online, but the PPI is usually a good predictor of kind of where things are going. So we'll have to kind of see
Hmm.
how that plays out.
Yeah.
Um, Switching over to consumer sentiment, the University of Michigan's preliminary August reading fell to 51 from a final 55.2 in July. That's a 7.6% monthly drop, and that's well below the consensus, which was about 54.5 to 55. And that's actually 12% or 12.4% below levels a year ago. And that breaks the trend we saw prior, which was two consecutive months of improvement. So I mean, obviously that even that 51 is still at a pretty low level. Even looking back historically, the biggest components that broke down, current conditions fell to 51.8 from 54.8. So we continue to see a little bit of a fall there. Expectations fell to 50.6 from 55. So I think expectations of the future and current conditions were obviously a major impact driver there. Um, the survey director, though, did note that views of personal finances declined only modestly. So I think overall people are feeling slightly better about their personal finances, but expected business conditions sank 11% for the short run and 17% for the long run. So consumer sentiment continues to remain relatively gloom. I think a lot of that is obviously people feeling the inflation expectations in the survey tick back up. The year ahead figure rose to 4.3% from 4.2%. The 5 to 10 year measures is held at 3.3%. So, we continue to see these expectations of inflation and business conditions continue to have an impact on the consumer. But the most striking single statistic was that only 8% of consumers now expect their income to grow faster than inflation over the next year. So that's a huge impact. So if you are, let's say, get a 4% or a 3% raise, let's say, but inflation is going at 4%, you're really losing 1% in overall spending. So,
No.
that continues to have an impact. And once again, I think is one of the clear signs we can see of the impact of inflation on the general consumer. The decline was broad-based across the political spectrum, interestingly enough. So Republicans, we saw the biggest drop month over month, now 19% below readings from prior to the Iran conflict. So, it's not just the one side of the political. We're seeing kind of broadly across older consumers, lower income, higher income, college degree. It's kind of broad. We're seeing impact as far as sentiment there. So hopefully it turns around. I mean, I think there's a lot of, as Brian said, alluding to, I think a lot of the issues impacting the consumer right now, as far as sentiment wise, can be rectified pretty quickly. As far as you get a ceasefire in Iran, things like that. We're still going to have shocks play out through, but there's a lot of things that can be done relatively quickly that can certainly brighten that up pretty quickly, I would say.
Well, then housing and jobs. Let's hear about that.
Yep. Switching over to the housing market, only a couple of items here. Existing home sales fell 1.7% in July to a seasonally adjusted annual rate of 4.06 million. That's down from 4.13 million in June, but up slightly from a year ago, only up about 0.7%. And then inventory tightened again. We have 1.54 million units. That's down from 1.9% from June, and down 0.6% year over year. So continue to see a tightening on the home sales, which I think overall is obviously impacting transactions, things like that. But we continue to see the median sales prices, hit records, and obviously it's supply and demand. We have a constricted supply. It's housing. Demand's always going to be there for the most part, and we're seeing that play out for sure.
Yes.
The jobs market for sure. July payrolls fell by 23,000. That's the first negative headline print of this cycle. And that was against expectations of an 80 to $95,000 gain. So that's a pretty big swing there. So we'll have to see, is that is that a trend we're seeing, or is that going to be just an anomaly? The composition of that miss was kind of pretty important though. Private payrolls rose 30,000, but government employment fell 53,000. So local governments, education, things like that were the primary drivers behind that miss. Retail and leisure, which were huge the prior months, I think came in a little bit soft. And healthcare, which was kind of been the biggest, I would say, growth engine, grew a little bit more slowly. So we saw kind of a pullback within the government jobs or government related, and really the other sectors didn't pick up as much. So revisions though were pretty brutal for the prior month. So May was revised down 66,000 to plus 63,000, and June was revised down to 37,000 or 37,000 from 37,000 to 20,000. So that's a combined a little over 100,000 fewer jobs. So this is always a bit of a tough. I mean, I think we highlighted this probably about a year ago, I think, when we had another major revision from the jobs numbers. So we'll see if that continues. Once again, we can only only go off the data we have. And as they get more data in, it certainly adjusts some of these numbers.
Well, Chris, I think that's a good trend. So since obviously government has important functions, and we need government jobs to handle those functions, but the private sector jobs offer a multiplier and a growth factor to it that government jobs don't. So if government jobs are waning, we've been hiring so many people, and private jobs are growing. That's a good thing. That's a really good thing for the economy overall.
100%. Yeah, I mean, that's what you want to see. I mean, you'd rather see that than obviously the reverse, where you have government jobs holding everything up and private jobs really cascading off. So I think that's a kind of a nice undernote to that.
Absolutely.
But the last thing I'll highlight, wages decelerated alongside jobs. So the average hourly earnings rose just 2 cents or 0.1%, bringing the 12-month or the yearly rate to 3.2%, which was below the 3.5% forecast, on the lowest since May of 2021. So, once again, I think bringing it all together, I think it highlights the fact that the consumer is starting, I think, to struggle keeping up with some of these inflation, and hence that's what we're seeing really play into sentiment and a lot of things like that. So, we'll see. We are starting to see that labor market crack a little bit. We're seeing sentiment remain a little bit sour there. But as I said, I think there is, from the positive standpoint, there's a lot of things that can fix a lot of these issues. One of them being, if you get a resolution to the Iran conflict relatively quick, you're still going to see a lot play out. You're going to see a lot of ripples, a lot of shocks through the market, but it'll go a long way in kind of putting things back into place where they need to be.
Exactly. All right. Well, good. Well, let's talk a little bit about the international markets, Chris. Japan recently has been the standout in the stock market. It gained the Nikkei index gained almost 5% the week ending August 14th. And it's moving, it's up almost 57% this year, strong technology earnings. But they also have inflation going on. And so bonds are flashing sell signals because rates are rising, and they are going to probably raise rates again. So they're in kind of this really strange situation where inflation is going up. They're raising rates to kind of tamp that inflation. That means bonds are going down, but stocks are going up. Kind of an interesting scenario in Japan. But Japan's markets have been dead for a long time. Everyone knows that Japanese market had been in a bear market for almost 35 years. Finally went above its previous high in 1989, sometime last year. So now we're starting to see some things happen. Japan is still the largest indebted country in the world as far as percentage of GDP. So maybe they're trying to grow out of that debt, Chris. We'll see if it works, and they don't have to completely blow up their economy. Also, just another comment. I mean, international stocks have still been very, very strong. Although, as Chris pointed out, U.S. stocks have taken leadership just slightly versus international. We have not seen an international stock rally quite like this in almost 17 years. So it's pretty interesting the last year or so. So the Bank of Japan's summary of opinions showed policymakers expect them to keep raising rates. So the Japanese stock market is going to continue to be part of that equation. Um, and we're looking, Iran announced on August 6th that it's going to join the BRICS New Development Bank. So there are groups that, because there's some conflict with the US, are trying to create their own groups, like a special bilateral, trilateral money cooperation program with other countries to avoid using the dollar. And that's certainly a risk for the US. But at the same time, the US economy is important enough that they can't completely get away from the dollar. But it's interesting to see the movements that are going on. And then Mideast oil is not expected to return to pre-conflict levels until at least 2027. So that's why we're seeing prices higher in the international market, and that's structural. It's not tactical. For anyone who's modeling out energy costs, you have to consider that. Once they cut down on the amount of oil that's being drilled, you can't just immediately turn it on. You got to go back to it and everything. But that's what's going on in the international. Moving to commodities, we talked about oil a little bit here. It's round tripped it very violently in the last couple of weeks. Prices sold off more than 7% first week of August, and then it rallied about the same amount as talks finished up. Now we're seeing that we're putting major economic pressure on Iran in a way that we haven't before, using all the allies around them, trying to strangle their economy because their leadership will not give up on the fighting and the conflict and everything else. So they're not saying this, but they're trying to actually cause regime change. They never want to say it, but we know that's really what they're up to. Brent crude settled at $88. It's a lot higher than it was a couple of years ago. And then West Texas Intermediate crude is at 82.40 on August 14th. So strategic petroleum reserve, however, in the U.S. has fallen below 300 million barrels. It's the lowest since January of 1983. It's a materially reduced policy buffer. If the conflict, escalates, that could be a big problem. So we'll keep watching oil. Gold is the year's best asset. It's spot held above 4,400. Everybody remembers when gold was well below $1,000 per ounce. Now it's in 4,400. It's up over 10% this past month, 33% for year over year. Touched a high on August 13th of 4,509. So again, it continues to be really a standout. You used to say that Bitcoin was the new gold. Well, now gold seems to be the new gold, Chris. Gold is back, right? And after running all the way up over $100,000 a unit for Bitcoin, Bitcoin has had a big pullback, and it's remained stuck in a range of 60 to 65,000 per unit. It's still up a lot from 10 years ago, tremendous amount, but it's down more than 40% year over year, and the trading at roughly half its 2025 peak. So on the poly market, the odds of Bitcoin outperforming gold have fallen to just 23% from more than 50% in January. So if it's behaving as a risk asset, not a hedge, which is what everyone thought Bitcoin was. So anyway, it's interesting to see where that is. And that's our story on commodities. And commodities and their inputs are an input cost to business. So they affect business a lot. And that's why we have to watch commodity costs. We have one portfolio at FourStar that does invest in commodities at the right time. And we've been in some commodities this year, and we're still in gold and a few other silver and a few other precious metals, but we're pretty much out of Bitcoin and a few others as well. So that's where we are. When we come back in our next segment, we're going to talk about all the crazy things we see out there, what we see out there, and then are you kidding me? We'll be right back, everybody. Okay, welcome back. Hey, Chris, what do we see out there?
Yeah, so the $1 billion Powerball ticket, so the Powerball lottery had over $1 billion, and the lottery ticket happened to be sold in the state of Illinois, in Quincy, Illinois. That represents the second largest lottery prize ever won in the state of Illinois. But one thing I thought was kind of fascinating is if the winner were to elect to take all of it in a lump sum. I think it ultimately, if you take it in a lump sum, it's like you get about half of it. So it's like a little over 500 million then. But once you factor in taxes and withholdings, they would just take home just 283.8 million. So it's still a lot of money, still very, very, very much life changing, but kind of a fraction when you think about it. People kind of put in their head, oh, 1.4 or 1.04 billion.
Oh
When
yeah.
you really dwindle it down after everything, you get about 283. You get about 20, 28% of it, call it, of really what you're expecting there. So thought that was kind of interesting when you really think about it. And then Josh Kushner and Bob Iger have just agreed to buy the Lakers at a record-breaking $12.5 billion transaction. So that's huge in the world of sports. And it's just coming off of LeBron leaving the Lakers, moving to the Phillies, or the 76ers, I should say,
Yeah.
Philadelphia 76ers, from that front. So continue to see huge transactions in the sport world. And then Meta, just last week, I started their landmark trial. And this is going to be really interesting, not only for Meta, but I think social media as a whole. I think it was California is the one that brought the trial to case. They're facing charges that they deliberately designed Facebook and Instagram to hook children, collect data on minors, and violation of federal law, things like that. So Meta has estimated the state's damage claims could reach $1.4 trillion, which is almost as much as the value of the entire company. So I think this is important to obviously keep an eye out on, not only for Meta, but as well as any other social media, things like that, because this has a potential to potential ramifications that it could ripple out beyond that. So, and then the last thing I'll mention, the total solar eclipse. We saw a solar eclipse sweep across Europe, primarily in Iceland and Spain, I believe, got the full eclipse there. And that's the first time we saw the solar eclipse cross mainland Europe since 1999. Spain set up 350 viewing sites amid heat and wildfire warnings that have been really sweeping across Europe. And I saw another cool viewing site that was actually in the Blue Lagoon in Iceland as well. So some really cool viewing parties there. People that wanted to travel to see these full eclipses, as you kind of saw that moon cross in front and cause that kind of sunset effect, that kind of blackout. So really cool solar event there.
Nice. Well, good. So what I see out there, Chris, the U.S., of course, had made some mistakes a number of decades ago by getting out of the rare earth business, and we need to get back in, and it fuels so many different industrial uses. And so we backed a Madagascar company in rare earths that was an attempt to loosen the supply chain grip that China has. It's an iconic clay deposits that are rich in neodymium. I'm not a chemist, but that sounds pretty heavy stuff. And paradisium and terbium, which are vital for the manufacture of magnets and used extensively for defense applications. So that's interesting what we see out there. J&J, Johnson & Johnson, reached a sweeping deal on their talc lawsuits. That was a big thing that's been out there for a long time, paying an estimated $5.5 billion, ending a big contentious litigation that's gone on for a decade. So I thought that was interesting. Also this week, more in the Washington scene, Anthony Fauci was found in contempt of Congress. He was obviously the leader of all the COVID activity, and it turns out very sad that he was not being honest with the public. He was saying one thing in his personal notes and then doing something else. I think that's probably why the Biden administration gave him immunity. They realized he was making some mistakes, or maybe who knows whether they were actually suborning those mistakes. Well, that's politics more than reality. But nonetheless, it's very sad. The granted immunity may not stand, so there's all kinds of things going on in Congress there. But that's really a sad thing to see. It's also interesting to see that every week we're having primary elections, and there's going to be a huge turnover in Congress. It's the biggest turnover in Congress in 6 decades this time. And one of the parties is nominating people who are not typically American style capitalists. They're communists, and they're trying to get in and change things. They want higher taxes, more services, but incentives are all capitalism, not socialism and communism. So we'll see if that trend continues. So that's something else that we see out there for sure. Um, and then, Chris, 60,000 people came into a small piece of Spanish territory on the Gibraltar Peninsula. Everyone might have seen this on TV, and it's in across from Gibraltar in Africa, African peninsula, called a little territory called Quetta. And basically, the prime minister said it's okay to come there, right? So guess what? People come there, and that's what was going on here, where people were flooding over the border. The word was getting out that the border was open, so people respond to incentives. That's what we learned at University of Chicago. People respond to incentives. And so if we give people an incentive to leave their terrible country and join a better country, they're going to do it. And so we saw that happen. But then, of course, within about 3 days, they realized the big mess they were in, and they got a bunch of those people to leave. So I think 48% of those, for 48,000 of those 60,000 have since gone back. So we'll see. Crime is down big, however, in Washington, D.C. That's another thing that came out. The Trump administration has made certainly some mistakes, but they certainly have been tough on crime, and they've cleaned up Washington, D.C., which was a crime-ridden and very sad-looking capital. So those reports all came out in the last couple of weeks, and that's really, really important to note. And when we bring in the military and other groups that keep crime from festering in a community, it's probably a good thing, right? So crime is way down. People are comfortable now to go out to dinner in Washington, D.C., and they're doing that in some other communities as well. So that's great news. And lastly, oh, yes, Chris, I live in a neighborhood where the Oscar Mayer company was founded. In fact, a school about 2 blocks from our residence is the Oscar Mayer School. And Oscar Mayer celebrated their 90th anniversary of the Wienermobile. And I thought that was important because the Wienermobile rides all around Chicagoland and all around, and so they do that to promote their meets, obviously. But that's big stuff, folks. 90th anniversary of the Wienermobile. How about that? Um, and that is it from what we see out there. But Chris, we do have a couple things for the "Are You Kidding" segment.
Yeah, I mean, I think one personal "Are you kidding?" and this is kind of personal to me as a Browns fan, but the Cleveland Browns announced that their beleaguered star quarterback that they gave a record-breaking contract of 230 million guaranteed money to is now starting after being booed by the fan base. And so this has really put up a lot in within the obviously I think political but sports world and market out there, and a lot of unhappy Browns fans out there. So it's a personal "Are you kidding me?" for me.
Absolutely. Well, and the other thing is, we have all these computers programs in the "Are You Kidding Me" segment that are supposed to, protect data and everything. Well, it turns out that the systems have gotten so good that they're hacking other systems. Anthropic had 3 of its major clients hacked in a capture the flag game recently, and there's been more and more reports about this where the systems they're creating are actually better at hacking than they are at protecting. And so we got to solve that one right away. And we're seeing a lot of hacking going on. And if anybody is working on their computer regularly like we are, we see constantly people trying to hack in, and you get weird emails all the time from people that have somehow broken into your system and stuff like that. So you got to keep changing your password. So hacking is becoming a big thing, and Anthropic was a big part of it. And then SpaceX, everyone knows, came public, and it's a great company. It's doing really well. The stock's been really volatile, though. Priced at 135, went over 200, went way back below pricing, and now it's back up. Anyway, but SpaceX had a rocket that crashed into the moon on Wednesday, the one that got away, I guess you'd call it. And it caused a huge crater dust up that they had intended for that rocket to go out in the sun's orbit and be gone basically forever. But it didn't work. And the last time that happened was when the Chinese actually had a mistake, and they had a 2022 rocket that went into the moon as well. So anyway, that's crazy stuff. And that's "Are you kidding me?" That is what's going on out there. All right. I think we're at the end of that segment, Chris. I just wanted to put in plug, everybody. One of our advisors at the FourStar Network, we're a network of advisors all across America. Richard Taylor out of Battle Creek, Michigan, home of Tony the Tiger and Post and Kellogg's, and it's like cereal haven over there. Richard does a podcast called Taylor Money Talks, and he has a big segment this time on Alexander Hamilton, who was Treasury Secretary at age 34. Very interesting to listen to. And Richard has a lot of really interesting things if you want to learn about the economy and money. Rich, listen, go on your podcast system, whatever it be, Spotify or Apple iTunes, and find Taylor Money Talks. So I'm putting in a little plug for Richard's show. All right, everybody. Chris, I think that'll do it for us today.
I think that covers it.
All right. Thanks, everybody, for being with us for another episode of Today's Market Explained. We'll be back very shortly. And this is Today's Market Explained. Over and out, everybody. Goodbye for now.
Take care, everyone.
Bye-bye now.